Hey everybody, Preston Brent here with our weekly roundup brought to you by our trader user group. This is for the trading week ending April 26, 2019. Well, the theme of the week is what goes up it must keep going up. The markets this week had a really good week. The Dow was the only exception, but it's still chugging along pretty nicely. The Dow was down about 6 basis points for the week. But the S&P, NASDAQ, Russell, all of them up for the week. NASDAQ making new all-time highs. And the Russell was up, playing a little bit of catch up. It was up for the week 1.59%. The S&P was up 1.2. Volatility creeped up just a little bit, creeped up about 5.29%. It finished the week at 12.73. Last week it was finished the week at 12.09, just to give you an idea, just a slight move higher. And across global markets, they're not faring nearly as well as the U.S. The FTSE, the London market, was down about 10. It was down just a little bit, 0.42%. The CAC 40 was down about 20 basis points. The DAX was up about 76 basis points. And Asian markets were a little bit mixed. The Nikkei was up about 26 basis points. China was down a pretty good bit, 4.31% for the week. And from a sector, excuse me, guys, got this crazy cough. Sector performance, healthcare was up about 3.72% for the week, a little bit of a bounce from the scare that they had with Bernie Sanders a couple of weeks ago. And the worst performer for the week was the material sector, coming in down about 1.96%. Now we are seeing the trailing PE ratio coming in still rather high at 21.98%. And the forward PE ratio is also creeping up as well. It finished up this week 17.61%. So that means the markets are pricing in not necessarily perfection, but pretty darn close. Remember, last January, the 2018 PE ratio got over 18. And then February, we kind of gave it all up. And generally, when the higher PE ratios go, stocks have to be damn near perfect to really maintain these levels. And what we're seeing in the markets is that a lot of analysts, as we get through earnings, we're about 47% of the way through Q1 earnings. I think about 236 companies reported since Friday's close. We're seeing, based on these lowered expectations for Q1, a beat rate of 80%. In Q4, we had a beat rate of 73%. But keep in mind, the expectations have been dramatically lowered. So that was priced into the market. And as most CEOs and CFOs do, they always sandbag the numbers and come in and have an average beat over 70%. Although we're getting really strong beats in Q1. So that tends to show that markets still have some oomph in them. And to kind of reemphasize that point, we saw this Friday US Q1 first pass GDP numbers coming in at 3.2%. So all in all, the economy, like I've been telling you guys on these weekly updates, I don't see a recession this year. I just don't see it. I do see some slowing in growth, and we can have a scare the children moment this year, but I don't see that. The other thing that I am seeing is turning into more of a stock pickers market rather than just some of these passive index funds that just buy the market and sit there. And the reason why I say that is last September, if you remember, the last time we had all-time highs, we had a pretty diverse group of folks, stocks that were at these all-time highs. Now, if you look at the markets where we closed this Friday, about half of those stocks that were higher in 2018 are down now, flat, zero, maybe slightly below zero. So we're getting less breadth participation as we move up in price. Now that's normal as markets kind of accelerate to the upside, but at some point it becomes an hindrance to momentum as stock prices move higher. But what's helping, let's not kid ourselves, what's helping stocks move higher is we've got this huge debate going on right now in the markets between debt and equity. Bond markets and the 30-day Fed fund futures is pricing in through this Friday about a 63% chance of one rate cut. So that's already baked into the market, more than 50%, 63%. So if the Feds, which are in a kind of a conundrum right now because the markets are showing greater strength than they thought, and they don't cut the rates, then it's going to make those higher PE ratios, as I said, the Ford PE ratio, which is the one we're most interested in, 17.61, even harder to maintain. And we're seeing that as companies come through their earnings. I mean, we're getting, Amazon just knocked the ball out of the park and they didn't really hit the expected move. They were well within the expected move. And then other companies that don't hit and really beat, they come in and they miss, they are getting taken to the woodshed. I mean, just look at Intel, look at 3M. I mean, they're getting killed. So it makes it harder and harder for companies to continue to outperform and drive those PE multiples higher. Now, I will say with the bond market, we actually, even on that GDP number, we saw interest rates go down for the day and bonds go up. So, which is a rare correlation with bonds moving higher as equities move higher. Generally, you get bonds moving lower and interest rates going higher for fear of inflation. But we don't have any inflation right now. We are getting a key inflation gauge this Monday. And the Feds follow this very closely. The personal consumption expenditure price index. It's a mouthful, but it's the PCE. And the Feds follow this very closely. It's expected to go up to about 1.4% year over year, and it's well under the 2%. Now, even if it stays at 2% or even goes slightly higher, the Feds are on record as saying they're going to let it run a little bit hot. So the markets have pretty much taken the Feds out of the markets, if that makes sense. But we're going to get Jerome Power Ranger Boom Boom Powell coming up this Wednesday in a press conference. Remember, every Fed meeting this year is a live meeting, meaning that he's going to do a press conference every meeting. It used to be up until this year, they would only hold press conferences on a quarterly basis, but now every time they have a Fed announcement, they're going to do it. And this Wednesday, we get the Feds come out. Everybody's expecting them to hold their benchmark Fed rate unchanged at 2.25 to 2.5%. So everybody's going to be really paying attention to the words out of the policy statement and what Boom Boom Powell is going to be saying at the 2:30 Eastern Standard Time press conference on Wednesday. So let's watch that very closely. Remember, even though the press conference is on Wednesday, they're going to have access to the data that we're not going to have as market participants until Friday, which is the employment statistics, and kind of giving a view on that as well as labor productivity. So they're going to have a better view than us, but let's see what they come out and say. Okay. It's going to be really important that we kind of see that. One other final thing, and then I'll jump into the charts here. The Barron's just came out with their annual survey of large institutional global money managers, and 49% of them are still bullish, 35% bearish, 16% neutral. Although they believe that more than the largest percentage of them believe U.S. corporate growth this year is going to come in between 0 and 5% for 2019, which is a big drop from last year. In fact, some analysts are saying on a go-forward basis, 2019 growth is going to slow down, not speed up. And then we got another group of analysts saying growth is going to speed up. So it's going to be a tug of war, not only between the forecasting side, but we tend to follow the credit markets here in our group, whether you trade them or not. Credit markets drive the equity markets. It's not the other way around, because money is liquidity and it's the source of what makes the capital markets work. So we're going to follow them very closely to see, and it's going to help us with expectations on just not only what the Feds do, but where equity markets really want to go. Okay. So as I said, there's about a 63% chance of one rate cut. That's what the bond market is saying right now. And you may be going, well, what's going to make a rate cut when the GDP came in at 3.2%? And that would be inflation staying benign, very low, right? and the market's dramatically slowing down in the second half of the year, which is what the bond market seems to be suggesting. Even though we've had a pretty good Q1 and we've had a great start to the month of April as we get, pretty much wrap up April going into May. And May is one of these sell in May and go away kind of thoughts. You've probably heard the saying before. But in the last couple of years, that has not been true. So perhaps this year it may resurface again. But with volatility very low, there's a lot of risk out there on the horizon. Any one of them, trying to pick one over the other is really not a fair thing to do. When the markets get overvalued or at above fair value, right? Remember the PE ratio on a forward basis, fair value is in the 15s. We're in the 17s now. So when it can take any one thing to light the match. Anything can be the igniter for the kindling in the firewood, so to speak. So let's watch these markets really closely. Now, what I've got on the screen here is the E-mini S&P 500 futures. You can see here as I blow it up, just to kind of show you real close, you can see the 2018 all-time highs here at 29.47. That was made in September of 2018. You can see how we closed pretty much on the highs. I mean, right up on the highs. And we made 2019 new highs at 29.4275. So we're less than, what, 4.25 points from making all-time highs. So that's going to happen. That's almost like a bug to a bug zapper on a back summer porch in a summer afternoon down south, right? It's just going to hit that bug zapper and just go right through it. That's just kind of how markets tend to work. But look at the regression channel on this daily chart. I mean, you can see the nature of this move right here. Okay, I mean, it's just moved up dramatically. Now, one of the things that's really interesting to note is that there was another study done by Goldman, and the whole market complex is changing a little bit and giving birth to even more volume in the options market. In fact, according to one of the studies out there under Goldman, 55% of the stock market's average daily volume on a notional basis was conducted via options versus stock. I mean, that's amazing. And it's showing market participants are using options more and more as a trading tool versus just using them as a hedging instrument. Now, for those of you in our user group, we've got a very extensive Option Masters education series that covers options in complete detail. And it talks about ways to use options and how to use options. And if you're not in our if you haven't enrolled in our Option Masters, I highly encourage you to do it, because options now are more a trading instrument, because a lot of people just can't afford to buy Amazon or Booking.com or Tesla or Netflix or Facebook or some of these others, and they're using the option market to play it. But if you don't understand options, you're going to lose your shirt. And most people don't realize, what I like to call in the option market the great white shark, which is volatility. And if you don't understand volatility, then you're clearly going to get killed. Okay. And there's ways, there's creative ways to structure option positions and option strategies to leverage volatility. In fact, whether you realize it or not, every trade you do, you're really trading, in essence, volatility. Okay. And certain strategies work very well in low to high vol markets, and other strategies work equally well in high to low vol markets. And it's regardless of whether you're bullish or bearish. So again, I wanted to just put that thought out there for those of you that tune in and listen to our updates and possibly use some options every now and then. I would highly encourage you to come in and check it out, because it'll certainly give you a leg up and a little bit of an edge. But I thought that study was really fascinating. So it just shows the option markets continuing to grow. But look at the regression channel on the E-minis. I mean, we're just riding this regression channel up. And if you guys remember, for our members, I was calling out going long the E-minis the second week in January. And I was expecting a little bit of a rollover to retest, maybe not the December lows, but at least retest this pivot point down here around the 2420 area once we got up around 2600. But we played long because that's what the price action told us to do, and then we hedged our bets expecting it to roll over. But as it didn't roll over, we still were able to participate in the longs. Unfortunately, and if I go into a weekly chart, what happened here in reality, as the markets rolled off the table here, a lot of people, especially what I term rat brain traders, and that's the common retail trader who always sells low and buys high, always late to the dance. Those are the guys and gals that you see at cocktail parties, and when you talk to them about the markets, they say, well, if you do the opposite of what I do, you'll make money. And that's more than half of the retail trader market anyway, because they don't know when to buy and when to sell. And we cover that extensively in our education series. But if you look at this, you can see here a lot of people got out of the market on this drawdown. And then they stayed out of the market here, expecting it to come back down again. Now, what's happened is we're getting that FOMO kind of thing, which is fear of missing out. So most participants expected the market to roll back over somewhere around the 2750 area. You can see these shaded areas here that represented major sticking points in the market. And it didn't happen, right? I mean, we had a little bit of a dip, but remember what I was saying, and I was telling our members, we were by the dip all the way up unless we were proven wrong, right? And even I expected the markets to roll over, but they didn't. But that did not keep me from playing bullish to the bullish side as the markets rolled up. So you just have to understand, you may have a belief, an internal held belief that says the markets are going to pull back 10% or 15%. But if price action's going up, you set that belief aside, you hedge for it, but then you play the price action to the upside because you got to always honor what price is telling you, right? The minute you start honoring your beliefs, then you're going to get screwed, right? It's just because I can't tell you how often price action is going to do the opposite of what you think logically it should do. Now, eventually you may be right, but it may take a year, it may take 6 months, a year, 2 years for you to eventually be right. But in that time, you're just sitting there and you're either losing money or you're sitting out the game. And that's not the way to play it. Okay. So you can see we're darn near close, just, a chip shot away from making new all-time highs. And that's going to happen. I believe that's going to happen. In fact, I had said that I believe the markets have enough momentum to get up to the 3,000 level. Maybe not without a few dips, but I don't see it really coming undone just yet. Now, I could be proven wrong. If I am, I'll shift my bias and I'll shift my positions pretty quickly and take advantage of that. But right now, I see any dip is still going to be bought. I will say, if you look at the 50 EMA and the 200 EMA, we're extended well above the 50 EMA, probably more than I would like. Okay, so this to me suggests a little bit of a dip, a dipping action here. I don't know if we're going to get market movement on the Feds this Wednesday. Markets tend to bounce around during the day of the Fed announce and then the press conference, but they always seem to reverse course again a day or two later and either give up what they got or make what they gave up, right? But this is where we're sitting right now. We're very close to all-time highs in the E-mini. And if we come over and we look at the Dow is the same. You can see here on the Dow, on this daily chart, here are the all-time highs made last September in the Dow futures, and this is where we sit right now, near the 2019 highs. Okay. Now, both the MACD and the E-minis and the Dow is relatively flat, just a little bit of a divergence here, not much. There's a lot of noise in the MACD chop there. So that suggests to me we're in a consolidation mode. You can also see I've got an Elliott wave 345. And for those of you Elliott wave enthusiasts out there, generally after a 5-leg, we get an ABC chop pattern, which would suggest a little bit of a down action, a little bit of up, a little bit of down, and then we'll kind of figure out where we go to from there. And that would be expected because we're near the 2019 highs and the 2018 all-time highs, and we're real close. Okay, this colored bar here was my target for the Elliott wave 5, and we're almost sitting right on it right now. So we hit my target already. And then, of course, if we look at the NASDAQ, on NASDAQ, note here that we're at all-time highs. So NASDAQ has already taken out its September all-time highs, surpassed that, and look at the MACD. A lot of chop, but flat. That suggests a long-term consolidation pattern, and this is indicative of either a market top or just a resting period before we march higher again. And this resting period is not just 1 or 2 days or even a week. Sometimes it can take 3 months to play itself out. And in that resting period could include a couple of dips. If we put it on a weekly chart here, just to kind of step it out, you can see here right now, there is a value area on this weekly chart around 74.10. We're at 78.79. So a pullback to that area to me would make sense. This yellow bar, that's where a lot of volume took place, overpriced. This is where bears and bulls were pretty much equal before we got that last push up in the end of March through April, right here, mostly contributed by the FANG stocks. So this is kind of where we're sitting here, okay? So expecting a little bit of a dip here makes sense. Notice on a weekly chart, we're on a 3-leg, so that does suggest a little bit of a dip here, and that dip can take us right back down here to this value area around 74.50 kind of range down here before we're making a final run up here and ending this bear market, secular bear market, bull market rather, I'm sorry, over the past decade or so. Okay. Now, one other chart I want to show you is the Russell. Now, the Russell was lagging. It was a lagging indicator. Here's the Russell futures. You can see here I put the regression channel on here. We haven't made a new 2019 high in the Russell since February 25th. Okay, this is Russell futures. Since Feb 25. All the other indexes have been making new 2019 highs and closing near current 2019 highs. The last one we made in the Russell was Feb 25. You can see we were making lower lows, lower highs on this regression channel. We broke out back here in April 10th timeframe. You can see this yellow bar represents the greatest amount of volume, meaning the bulls and bears were pretty much equal here, sitting at 1572, and that's kind of what's providing support right now. So there's buyers underneath here. You can see also on the 50 EMA, we just got across on Friday of the 50 moving over the 200 EMA. And you guys may have heard me say before, typically when you get a cross in the EMAs, the 50 and the 200, whether the 50 is crossing to move down or crossing to move up, it serves as either a support or a resistance point because of the timing of it. You know, by time it crosses, the markets have already made a pretty good move, so it'll serve as a resistance or support point. In this case, a support point, okay, which is right around the 1555 area. And that would not be a big pullback. We're at about 1594 right now, but that would represent a support zone. Notice when we broke this regression channel, we did test it and we're trying to make new 2019 highs. This is my target area for the Russell, right around 1635. Not sure if we're going to make it. We're starting to set up for a little bit of what we call a poor man's divergence. Right here, we got a lot of noise and chop in the MACD, not as smooth as I'd like to see. We haven't made new highs here. So it's a poor divergence, but the probability and the edge is still greater than 50%. Okay, when we get the trigger. So this is kind of where we're looking at across these indexes. Now, if we look at volatility, we're still well in the green zone here. Okay, the green zone means it's different types of option strategies you want to deploy. Okay, and we're towards the upper end of it, but we're still in the green zone. So you basically want to be long gamma, long vega type strategies. And if you are selling credit spreads, make sure you're doing them the right way. Okay, and this is kind of where we're sitting here. If we look at the front month skew, this would be comparing essentially the VIX to May futures. And you can see here we're in the green. So it's in a contango environment. That is the term structure that we want to see. It shows there's no fear going out through May. And then if we look at the back month, which is May and June, or let's go to May. Let's go to the back month, which is May and June. It's even further in a contango. So there is not that traditional sell in May and go away kind of fear. The markets have kind of settled in almost to a point of being just slightly complacent. Okay. As I said, the breadth of the markets, if you're looking at the McClellan oscillator, which we review every Sunday evening, and we got a couple of different, I've got a couple of ways of using the McClellan oscillator and the McClellan summation index to just look at market breadth, along with the put call ratio and the CBOE skew index. It tells us that we got to be careful right now. Okay. And this right here is primarily used for trading VXXB. Okay. Now, I believe the name's going to change back to VXX in May. But either way, it's a good tool to use because it creates a negative roll yield in VXXB, or VXX if they go back to that name, which is what we like in the way and the strategies that we trade it. So that's the volatility market. Now look at the interest rates here. It's right at my target, and it has been sitting around my target. Remember, let me just take this and just put it on a weekly and then come back to a daily again so it doesn't get that message on my screen. My target, and I put this target on here well back into January of this year, was 2.5. You can see we blew through it to the downside, blew through it back up, and now we're settling in here. It's going to provide support right at about 250. Okay. And it's going to be interesting to see because generally when we're at all-time highs in a market, okay, all indexes getting near all-time highs or making all-time highs, I would not expect to see interest rates here. I would not expect to see inflation as low as it is. I would not expect to be hearing boom, boom Powell say we're on the sidelines right now and not thinking about a rate hike. And I would not be expecting a 63% probability of a rate cut before the end of the year. So there is something wrong with this market. And that's what happens when you put trillions and trillions of dollars of stimulus into the market, 4 trillion in the US alone, right? And there's still almost $10 trillion of government debt, government debt that's still below zero, negative, carrying negative interest rates. So there's going to be some hell to pay when the markets finally roll over. Everybody that's calling for catastrophe, eventually they're going to be right. I just don't think that's going to happen this year. Okay. Not unless we get a dramatic surprise somewhere geopolitically or something from China or something like that. I don't think just normal market machinations is going to happen in 2019. Probably more likely towards the end of 2020 going into 2021 is what I would expect, unless the markets change, of course, because I wouldn't believe my forecast. I just look at this stuff and see what it's telling me right now. Okay. I'm not going to go into the currencies. We will look at oil here for a minute. We've had a huge run up in oil. You can see this move here. And we've stayed within this regression channel. For our members that took the trade, we've made a killing in oil. Back over here, I was suggesting we go short. Members took the trade, made a killing on oil. I had called oil down to about a 62 level when oil was up around 75, and it blew right through 62. It actually came down here to a low of right around 42 and a half, roughly. And then we got a buy signal back around 28 December to go long, right? And we had a couple of members come into this and trade that as well to the long side. Again, just some really great trades in oil from a directional perspective. Trying to trade oil, using credit spreads has been rather difficult, but being long gamma in this trade has been really great, especially if you understand options in the oil futures market. It's really been a great trade. Now, this past Friday, you can see oil fell $2.41. And a lot of that was because of Trump's tweet on getting Saudi Arabia to cut their oil. We're seeing some increase in oil inventories. I still am sticking to my story that oil is probably fair value is in the mid to upper 50s, somewhere between 55, 58. But if you look at the daily chart, you can see we've got a couple of fair value prints, one around 52. And then we got another one way up here at 64. And if I put it on a weekly chart, because oil has just moved so much, I mean, it looks just like the equity markets. There's a fair value in oil sitting around 64. And then there's another one sitting here right around 56. And I believe that somewhere between 56 and 64 is where the fair value of oil is going to be for the next 6 months. Okay. So up in this level here, that would suggest you may want to think about shorting oil or doing some bear put spreads on the oil market up in this area here. But keep in mind, we're getting the 50 looking like it's going to cross back over the 200. We're getting towards the lower boundary of the regression channel. So if it holds, then you want to be more. I'm not a buyer of oil. I'm sitting out the oil. I think it's had a big extension, so I wouldn't be recommending longs here in the oil market. But this is kind of what I'm looking at here with oil. Gasoline, same thing. It's had a humongous run to the upside. I mean, just humongous. And I'm hearing analysts say it can go even higher. All right, we got the signal to go long again. Gasoline contracts towards the end of December, right? Turned out to be a great trade. Notice with gas, we've got well the 50 over the 200 EMA. We're still in this upward. I think gas is a little bit more bullish than oil at this point in time. Okay. Um, Nat gas, no. Nat gas is, we came right down and hit my target, both time and price. Okay. Remember, I said that would be the target. So for nat gas right now, I would be more inclined to be doing bull bull um, bull put spreads here. Just doing credit spreads underneath the market because I think it's going to kind of hold down at this level down here in nat gas. Okay. Now there are other markets that are bouncing around a pretty good little bit. For our members, we'll go into them this Sunday evening. And like I said, if you're not a member, I highly encourage you to come in, take advantage of some of these coupon offers we're putting out. I'd love to see you guys in. We've got a pretty good, diverse international group of folks. And as you can tell, we do a lot in the futures market, commodity markets. We use options. We're bouncing around stocks as well. So we've got a lot of things that we're playing here. We had a good year last year, 2017. We're off to a good start this year. And I think we're going to get some scare the children moments in 2019. So we'll take advantage of them when they happen. All right, everybody, have a really great weekend, remainder of the weekend. Members, I will see you this Sunday night for our weekly market watch. Have a good one, folks. Ciao now.